All right, welcome everybody to today's webinar. My name is Steve Mahoney. I'm with Kathleen Thompson. We're both the mentors with the Greater Hartford chapter of SCORE. Today's topic is understanding your financial statements. We're going to go through all aspects of the different financial statements that impact your business and answer any questions you have as we go through this. So today's agenda, as we talk through this, we're going to talk about why managing your business finances is important. There's a couple obvious reasons, but some that might not be so obvious. Then we're going to go deeper into the key financial concepts and understanding your different financial statements. A lot of you are probably using a financial software like QuickBooks or other similar softwares to run your financial statements. We'll talk to you about what the key things to look for when you're reviewing those, the income statement, the balance sheet, and the cash flow statement. Then we're going to go through a little bit of detail about how different business transactions impact your financial statements. This is a little accounting detail, but it's helpful for a lot of the clients that I work with to understand how something like paying debt or paying yourself an owner's draw impacts your financial statements and why it impacts some and not others. So we'll talk a little bit about that, and then we'll answer any questions folks have. So a key thought that I'd like you to leave with tonight's session is that you don't need to be a CPA to run your business. You don't need to be an accountant. You don't need to have all the accounting education and classes and everything, but it is important for you to understand some key financial fundamentals. So that's what we're going to really cover tonight. And the goal for us is at the end of this hour is for you to walk away with those key financial fundamentals and then take that forward, whether you're working with your accountant or your SCORE mentor or someone else to understand your financials. All right, so let's jump right in. So why is this topic important? Why is it important to manage your business finances? Well, the first one that comes to mind, people usually think of is taxes. They think, well, I got to do records. I got to keep my books so I can do my taxes at the end of the year. That's important, but it's not the only reason. It's good to understand your financial statements because it can help inform the trends that are going on in your business and in the market. What are you seeing happening with your revenue? What are you seeing happening with your profitability over time? So looking at your financial statements, it's not just a record keeping exercise. It's not just scorekeeping. It's key to understand what's happening with your business. Another phrase that I like to use with folks is that the past can inform the future. So as you think about what's happened with your business over the last 3, 6, 9, 12 months, that can help you understand where it's going. What are you seeing happening with revenue and pricing? Is it going up? Is it going down? What's happening with customer demands? What's happening with the cost to run your business? Are you seeing some inflationary pressures that you need to compensate for? So understanding your past financial results can help you make better future business decisions. And then it helps to answer some key questions. Can you make more money running this business? Is your product or service priced right? And what might my business look like in 1 to 3 years? So keeping in mind that kind of past informs the future is a key aspect of this. So we're going to start first with what's called the income statement. Now, it's also sometimes called the profit and loss statement, or P&L for short, which stands for profit and loss. Anytime you hear those phrases, it's the exact same financial statement. So what the income statement does is it measures profitability over a period of time. So I've underlined that phrase because it's a key concept. When you talk about your income statement, you're talking about it for a month or maybe a quarter or a year. It's over those 3 months or over those 12 months. How much revenue did you collect? How much profit did you make? The typical line items you would see on an income statement are listed out here, and I want to go through them in a little bit more detail. And we've got an example in a slide or two that'll show you what some of these things look like and how to interpret it. So the first is revenue or sales. So this is the top line money that you're bringing in from customers. This is simply how much did you charge for your product or service? How much did your customer pay you? That's called revenue or sales. Sometimes you'll hear that called income. I think of income more like profit, which I'll get to in a minute. Revenue and sales is that top line number. Cost of goods sold, sometimes abbreviated to COGS, is the cost to acquire a product that you're selling. So this is really applicable if you're in the retail or manufacturing space, or if you're buying something and reselling it. If you're in the services business, cost of goods sold isn't really a concept because you are selling your time, you're selling your services. A cost of goods sold might be if you were manufacturing something in a machine shop, or you were buying something and reselling it for a profit after you added something to it. So cost of goods sold really applicable to that retail and manufacturing environment. The next concept that you'll hear about is called gross margin or gross profit. This is simply sales minus cost of goods sold. So think about this as if you're buying something for $20 and you're reselling it for 30 per unit, that $10 difference is your gross profit. And so this is, again, not really applicable for services businesses, but that's the key concept to understand for something like a retailer or manufacturer. The operating expenses, these are costs to run your business. Sometimes you'll hear the phrase overhead. Overhead are really fixed costs, but the operating expenses can include fixed and variable. And we'll talk about those in a little bit more detail about what that really means. And then the last item is what I call pre-tax income or profit. So this is basically sales minus cost of goods sold minus operating expenses. Basically, how much money did you have left when you think about the operating activities of your business? Now, there's other components of an income statement like interest expense or income taxes, but these are kind of the key things as you think about the core operations of running your business. So let's look at an example. So this is one, just a sample income statement for a made-up business. And you'll note that it's got cost of goods sold. So this would be kind of that retail or manufacturing example. So as you think about this, revenue is always the top of the page. Your cost of goods sold will come next. And then you can see the difference between the two is your gross profit. And then you list out your expenses. These are listed in kind of random order. It kind of depends how your QuickBooks gets set up in terms of how your expenses are going to get displayed. Some businesses will show other more prominent expenses up front and other minor ones below. You can really kind of customize it however you want. And then you've got down, this business has all their expenses. They've got an operating profit down here, which is basically this gross profit minus all their operating expenses to get it down to operating profit. They've got some interest expense because they're carrying debt. Then they pay taxes, and then their net profit is their bottom line profit. This is what's left at the end. You've collected your revenue, you've paid your expenses, you've paid the government your taxes, you've paid your bank your interest expense. This is what's left in terms of your net profit or your net cash in terms of what you want to do with that. So the key questions to think about as you're going through an income statement for your business is, if you're looking at just a standalone period of time, like a month or a quarter or a year, let's say, you want to look at these on an absolute basis to ask, like, how much is my business generating in gross profit before I pay the expenses to run my business? So in this example, they've got things like marketing and staffing and supplies. These are the costs to actually run their business. The gross profit is their contribution margin towards paying those expenses and covering your profit. Now, if you start to see a problem in your gross profit becoming strained or really too low, and it's not covering your expenses, this is where you have to ask yourself, what are the strategies I can do to improve that number, right? There's different levers you can throw. You could try to increase revenue by either diversifying your product line, changing your pricing strategy, finding new customers. You could try to improve your cost of goods sold by lowering it by maybe getting a better deal on what you're buying from the vendors that you buy from. There's multiple levers you could do to try to improve this gross profit number and make it higher. So the next thing to think about when you're looking at your income statement is your expenses. And when I look at an income statement, the first thing I try to do is figure out what are fixed and what are variable. So how do you think about this? Fixed, you may think fixed means it never changes. That's not necessarily true because all costs usually go up because of inflation. Fixed are expenses that don't change with revenue volume, meaning things like rent or your business insurance. If you sold, 1,000 units or 0 units, you're still going to have rent on your facility. That's a fixed cost. A variable cost would be a cost that might go up or down with your revenue. So thinking about a restaurant that was open, if they decide to expand from 5 days a week to 7 days a week being open, their revenue is going to go up because they're going to have more days open and more customers, but their staffing costs are also going to go up because that expense is going to be higher because they need more people to service the customers. So fixed expenses are not related to revenue volume. Variable expenses are. You do find sometimes that you're going to have some expenses that might be in that gray area. Sometimes you'll say, well, I have a couple people that are on staff here, but if we do have more business volume, may need to add 1 or 2 people. So maybe it's kind of fixed, kind of variable. The goal is to try to understand your expenses that are kind of the black or white and don't necessarily worry about the gray too much, or maybe assume it's a 50-50 split. The reason it's important to understand why your expenses are fixed or variable is because this can impact your profitability if you start to feel some revenue pressure. And what I mean by that is, if your revenue starts to go down, you need to understand, what are the total fixed expenses I need to run my business every month. I know that I need to collect at least that amount of revenue to cover my fixed expenses, and then I've got to think about revenue to cover my variable as well. Because if your revenue went below a certain point, those expenses are going to be there. If you decide to close your revenue or close your restaurant from 7 days to 4 days because you're having some financial pressure, yeah, your staffing costs are going to go down. Your food and ingredient costs are going to go down because your variable expenses go down. But that rent is still going to be there because you're still in that building. That's a fixed expense. It's not going to go away. So that's important to understand for businesses that are shrinking or growing, being able to understand which expenses are fixed and variable, because you want to control those fixed expenses as low as possible because they're just overhead. Things like your insurance costs, you want to be responsible and get a business owner's insurance policy, but ensure that you're marketing or you're finding a good market rate, and that it's a competitive rate. And you want to try to get the best rate on your utilities and your rent and things like that. So the other question to ask yourself as you're going through your expenses is, how can I become more efficient? How can I think about ways that I can not just cut expenses because they improve my bottom line, but how can I do it cheaper? How can I do it better? How can I do it faster? Thinking about maybe a staffing model, thinking about how many employees you have, if you've got, a large group of people. So those are the ways to think through your different expenses. And my advice when you're looking through this is focus on the items that are going to really move the needle, right? In this example, you can see that a good chunk of their expenses here are staffing, marketing, and their legal costs. Well, maybe there's a way to lower their legal costs because maybe they can talk to their attorney about how much they can spend on legal costs each year. Maybe they don't need to travel as much based on what's in their budget. Marketing is a tricky one because marketing leads to sales. So you want to be careful not to cut expenses that are going to impact your revenue growth. The way to say it is, how can I maximize? How do I spend that $50,000 of marketing? Or if I'm going to cut it to 40, how do I try to get a better return on how I spend that $40,000? So these are the kind of key questions as you go through your income statement and evaluating it. And that would be an example if you're looking at it for the month or for the quarter. Now, one thing I will caution you on is trying not to make too many broad business decisions or major business decisions based on 1 month of results. You want to look at a trend. So one of the nice reports that I like in QuickBooks that I sometimes review with my clients is a monthly trend for the year. So if I were working with a client right now, I'd say, run me your income statement for January through August by month, just so we can see what's happening for the 8 months year to date, and we can kind of see what's happening month in and month out. That can help show a trend of what may be happening with certain items like revenue or profitability. So it's important to understand what's happening month to month, but you don't want to make any rash decisions based on 1 month of results. You want to look for those trends and see what's happening over time. So let's talk about the balance sheet. So I mentioned that the income statement presents activity over a period of time. So it's for like the month ended August 31st, August 1st through August 31st. How much revenue did I collect? How much expenses did I pay? A balance sheet is as of a point in time. Think of it as a picture. It's a snapshot of your business as of a date. It's not for the year ended December 31st. It's as of December 31st or as of June 30th. And there's three components of a balance sheet. And I'm going to show you an example one in a moment. There's assets, there's liabilities, and there's owner's equity. So here's what each of these items are, and you'll see an example of kind of how they get displayed in a balance sheet on the next slide. So assets are simply what your business owns or what others owe you for your business. So for example, any cash you have in the bank, your business bank account, any investments that your business invests in, these are only business assets, right? This is not your house. This is your business bank account, your business balance sheet. Accounts receivable you may have from your customers. If you sell to your customers and they agree to pay you within 30 or 60 days, that's an account receivable. That's an asset to you until you collect that cash. Any inventory you have on hand, if you're a retail or manufacturing environment, and then any equipment you have. Sometimes places will have, whether you buy a computer or a piece of machinery or a truck, let's say, for your business. Those are all assets for your business. They're on your balance sheet because you own them. Liabilities are the opposite of that. They're what's your business owes to others. So the most common one is accounts payable. So if you buy something for a vendor and they bill you, you owe that money today, and let's say you pay it within 30 days. Money that you're going to owe to the IRS or the state for your income taxes. And if you borrow money from your bank, that loan that you owe the bank, that's a liability on your balance sheet. Owner's equity is the last item in a balance sheet. The textbook definition of this is the book value of your company. It's sometimes people also say it's the difference between assets and liabilities, and that's technically correct because a balance sheet balances through that equation. It's not the fair value of your company. It's not what somebody would buy your company for today. That's a different analysis for someone. If you wanted to say, what would somebody pay for my company? That's a different analysis. The balance sheet represents the history of what's happened to your business through all the activity that's gone through your income statement and equity statement over time. The mathematical way that you calculate your owner's equity is at the bottom of the page here. Any money that you put in increases your equity. So any capital contributions you make, any profits your business makes causes your equity to go up. Losses cause it to go down. And if you take any money out as an owner's withdrawal, that also reduces your owner's equity. So all of these transactions that happen day in and day out for your business, from the day you started it to the end of today when you run that report, they all get added up, and that's what creates your owner's equity. So it's a little accounting textbook logic, but that's technically what it means. So let's look at a balance sheet example. Again, this is just a made-up company. I just want to walk you through how the data is typically organized and what it really means. Typically what happens is assets are on the left-hand side of the page, liabilities and equity are on the right-hand side of the page. You'll notice that the balance sheet has the word balance in it, and that's because it must balance an equation. Total assets must equal the sum of liabilities plus equity. So you'll see in this example, the total assets for this business, $910,000. It has 450,000 of liabilities, 460 of equity. The sum of those two is the same $910,000. So let's just talk about kind of how this is organized. Typically, businesses will have their balance sheet. Their assets are organized from most liquid to least liquid. So what does that mean? Most liquid means either cash or things that you can quickly turn into cash. So when you're getting evaluated by a bank, let's say, in terms of your financial health, they want to see that you've got a lot of liquid assets. If they see that most of your assets are tied up in fixed assets or a machine shop, and you've got very little like cash, receivables, or inventory, they may be worried about how liquid you are. And the reason that's important is, you know, you can turn cash, you can pay bills quickly, right? Because you have the cash. Receivables, you're going to collect from your customers quickly, so you can turn that into cash and pay your bills. Inventory, you can sell it and pay your bills. If you've got a shop or a truck, it's going to take you longer to sell that piece of equipment or that piece of real estate to turn it into cash to pay your bills. So you'll notice on this example, and most balance sheets are organized this way, that you start, cash is always the first item listed. Then it's got kind of the items that could quickly convert into cash. Short-term investments, this is probably like a money market fund. Accounts receivable, you're going to collect that cash from customers very quickly. Inventory, you're going to sell that inventory very quickly to customers and turn it into cash. Prepaid insurance is something where if you get a discount by paying your business insurance a year in advance, let's say you pay it all up front instead of by month, that's called a prepaid asset because that's just a future expense you've paid. Then this business has other kind of stock investments. And then you can see down here, they've got land, building, and equipment. These are those fixed assets. And these are usually listed towards the bottom of the balance sheet because they're what are called longer term assets, meaning you're going to have them on your balance sheet for a long period of time. There's some other items down here that are goodwill is related to acquisitions, which we're not going to go into in detail today. On the liability side of the balance sheet, similar concept. Your accounts payable are usually listed first because you're going to pay those pretty quickly to your vendors. Salaries to your employees, same thing. Interest payable, same thing. You're going to pay that interest to your debt holder with your bank. Any income taxes payable you owe to the government, these are your liabilities. I did want to point out that the debt on this balance sheet is split into two portions. There's what's called a current portion of debt for this $40,000. Then there's a notes payable for 110 and a bank loan and a mortgage obligation. Typically, what businesses will do is the current portion of a liability represents what they would owe within the next 12 months. That helps readers of the financial statements, whether it's a bank or an investor, understand what is this business going to owe in liabilities in the next 12 months. So if I'm evaluating a balance sheet, one thing I might do is say, all right, well, they've got current assets of $450,000. and current liabilities of $150,000, that's a metric that people will look at on a business and evaluate, okay, they're in good shape. They've got plenty of money in their short-term assets that they can cover their short-term liabilities. They seem like based on that one fact alone, they'd be an okay credit risk. But I'd also want to understand what are their long-term obligations and know that they do have other mortgages and long-term debt. So that's another factor to consider. You can see down at the bottom here, this is stockholders' equity, capital stock of $300,000. Capital stock or common stock or whatever it's called in your equity statement in your QuickBooks is really the sum of money you've put in minus money you've taken out through an owner's draw. The net of those two is really the capital stock. And again, this is as of a point in time, so that would represent money that you've put in minus money you've taken out all through history. Retained earnings is the sum of all your profits since your business began. Net profit causes retained earnings to go up. A net loss causes it to go down. Now, you don't have to calculate all this stuff when you're doing your books. You don't have to calculate all this historical information. When you keep your books day in and day out, it will calculate your equity automatically for you. So don't feel like you got to go back in time and calculate all this stuff for history. Your financial software will do that for you. But just to point out, in this business, you can see they've got $910,000 of assets, only 450 of liabilities, and 460 of equity. That's a good story for me. That tells me they got positive equity, more than enough assets to cover their liabilities. They do have some intangible assets, goodwills, results from an acquisition, and they do have some longer term assets, but those are a few positive, steps in the right direction. I'm going to run through this rather quickly just to talk to you about kind of what happens when certain transactions hit your financial statements. This is, again, a little accounting textbook, but I created this for one of my clients a while ago because we were going through their income statement and they said to me, where's my owner's draw? How come my owner's draw is not on my income statement? How come my payment to my debt, my bank for my debt is not on my income statement? And I said, well, it doesn't go through your income statement. It goes to your balance sheet. And they said, what do you mean? So I said, well, let me put together a simple spreadsheet and explain to you kind of how this works. So I created kind of just a simple income statement and balance sheet here. I'll try to go through this quickly to not bore everybody too much. But you can see at the top here, this is, a simple P&L, simple income statement, revenue, cost of goods sold, net profit, balance sheet, simple, a few line items here and there. And I basically said, let's pretend we're creating transactions for this company. What does it do to your financial statements after each one of these things happen? So the first thing we're going to do is we're going to put money into the business. We're going to put $50,000 of cash into our equity account. No income statement income impact doesn't impact your income statement. You basically put 50,000 of your business cash in your business bank account. You've created equity. Your balance sheet now has 50,000 of assets and 50,000 of equity. Let's say you buy inventory from a vendor for cash. Again, no income statement impact. You haven't sold anything. You haven't expensed anything. You just bought inventory. Your cash goes down 15,000, your inventory goes up 15,000, your total assets haven't changed. You've essentially traded one asset for another. Then let's say you sell some of that inventory to a customer. And let's say you sold it for 12,000 and it was $12,000 of cost to you and you made $8,000 of profit. So what happens? Well, that's what's on your income statement. You have net profit of $8,000. Your balance sheet, you sold it on credits. You have a receivable now of $20,000. That's an asset to you. Your inventory went down $12,000 because you sold $12,000 of product. And your equity goes up $8,000. That's your net profit. You made $8,000 of profit. Your equity is now higher. So you can see how in each one of these transactions, the balance sheet always remains in balance because they have to offset each other. Let's say you collect a portion of those receivables, your cash goes up, your receivables go down. Again, not an income statement income impact. You haven't sold anything or expensed anything. You just collected a receivable. You pay your rent with cash, similar type thing. You've got an operating expense of $1,000. Your cash goes down, your equity goes down because you had an expense to your income statement. This is an interesting one. Let's say you finance the purchase of equipment. So you went out and bought a truck or a piece of machinery for your shop, but you bought it all through debt. You didn't pay any cash. So what happens on your balance sheet is you put that asset on your books because you now own it, but you also put debt on your books because you have a liability to the bank. So if you were to run your balance sheet out of QuickBooks, you would have that asset and you'd have that liability that would be equal and offsetting. And then let's say the next month you go ahead and make a payment of that debt and it's $3,000 of principal and $300 of interest expense. Your interest expense goes through your income statement and your principal goes through your debt line on your balance sheet. So, your cash goes down $3,300, but some of that was repayment of principal, the $3,000 of it, 300 of it was interest expense. So that's the only piece that runs through your income statement. And then let's say you take an owner's draw of $5,000. That doesn't go through your income statement. It's just not how it works from an accounting standpoint. Your cash goes down and your capital account goes down in your equity. So you remember that 50,000 we put up at the beginning, you're basically withdrawing $5,000 of that. And again, your assets and your liabilities and equity are equal as you go through each transaction. And then what I just included on the right here is just a total, which basically sums up all of these transactions over to the right, such that you can say, for this period of time, for these whatever 7 or 8 transactions, the business recorded revenue of 20,000. They had cost of goods sold of 12. They had operating expenses of 1,300. They had net profit of 6,700. Here's their balance sheet as of the end of the period. I just ran my balance sheet after all these transactions. Here's how much cash I have on my balance sheet, represents all these increases and decreases. I still have some receivables. I have some inventory left. I have that equipment, and my total assets are 96,700. I still have my debt. I borrowed 48,000, but I paid 3,000, so my remaining debt balance is 45,000. And then in my equity section, I've got 45,000 of my capital account, which represents that money I put in of 50 minus the 5 I took out in my owner's draw. And I've got $6,700 of net profit or retained earnings, which is the same number that's on your income statement. And you can see the total assets of 96.7 equals the sum of the liabilities and equity. So again, very textbook accounting, but but I wanted to just explain to folks why some of these things, especially debt and owner's draws and buying equipment with financing, they don't run through your income statement, which is why the balance sheet and income statement are both important to look at. So hopefully that's clear, but if you have questions as we go along, please drop them in the Q&A box. So let's talk about the third financial statement, and that's called the cash flow statement. So this is probably the easiest one to think about in terms of concepts because you don't really have to know a lot of accounting to understand this because it's simply cash moving in and out of your business bank account over a period of time. So this is like the income statement. You look at your cash flow statement for a month, a quarter, or a year. It's over a period of time. It's not a snapshot point in time like the balance sheet. It's over that period of time. So you'll want to say, how much cash did I collect for the month of September or September 30th year to date? Very simply, cash flow is positive when actual receipts exceed actual disbursements, and it's the opposite. Cash flow is negative when the opposite occurs. When you're thinking about the cash flow for your business, there's really 3 categories that businesses look at. And we're going to go through each of them, and I'll give you some examples of how they impact your financials. So they're called operating, investing, and financing activities. And it's very important to understand how the cash is moving in and out of your business financial statements because they can tell a kind of a different story depending upon what's happening with your business. So let's talk about operating cash flows first. This is, in its strictest terms, it's really inflows and outflows from what I would call ongoing business activities. This is very close to your income statement for a lot of startup businesses. It's cash inflows are revenues that I collected from my services or revenues that I collected from selling my products. That's generally what your cash inflows are going to be. Whether you collect that money up front or you collect that money a month or 2 later from your customers, it's a cash inflow because you collected the cash. Cash outflows for operating activities are things to run your business. Cost of goods sold for selling your products, paying your employees, paying your fixed expenses, things like utilities, insurance, or legal costs, things like that. As I mentioned, going through the income statement, it's important to understand in your cash flow statement and in your income statement which of these items are fixed versus variable. So looking at these 2 financial statements through that lens is important, as I mentioned earlier. So what are the other 2 categories? So financing and investing are more kind of strategic items that impact your business, but they're not part of ongoing business operating activities. So the first is financing. So this is how you kind of create the cash to run your business or start your business. So it's usually is going to come either from, it's going to come from you or an investor or a bank. So if you borrow money from a bank, that's a cash inflow. If you make a loan payment out to pay that debt down, that's a cash outflow. Um, when you put money into into your business bank account as a capital contribution, that's a financing inflow. And then if you take your owner's draw out, same thing, it's a financing outflow. So that's important because this kind of goes to the concept of why doesn't the owner's draw show up on my income statement, or why doesn't my debt payment? Because it's not part of your core operations. It's important you understand it because it's your cash account and it impacts your cash balance, but it doesn't show up on your income statement. But anything that impacts cash shows up on the cash flow statement. Investing, this is the other main category. This is the third one. This is primarily when you're buying new equipment, machinery, or some kind of capability to invest in your business. Not going to be applicable for some businesses, especially in the service industry. But if you're buying a new piece of equipment, buying a new truck, I've gone through meetings with clients who are in like the construction industry or in like the kind of home repair industry. And we'd go through their financials and I'd be like, well, what's this item? What's this big expense you had this month? I'm like, well, that's the $13,000 I spent on the new truck. I'm like, well, that's really an investing activity. That's not part of your core operations. That's an investment you're making now for the future. So it's important to kind of keep track of these separately as you're thinking about your cash flow results. And whether that's in your QuickBooks or any other analysis that you're doing, it's important that you kind of carve those out so you know that when you look at your cash flow for the month, wow, my cash flow is really negative. Things, I may be in trouble. Well, maybe you took the opportunity because you had extra funds to go invest back in your business. That's okay. The key question to ask yourself is, can you afford it? How does your outlook, look for, cash over the next several months or years to be able to afford being able to pay that, pay down if you're going to be borrowing money, or can you ensure that you can afford to invest that now? Is it going to generate profit, whether you're, more revenue or lower expenses? That's how businesses think about that investing capability. So you've got the three components of a cash flow statement. You've got operating, you've got investing, and you have financing. This is an example of a cash flow statement. Again, just a made-up business. And you can see that the activities are broken out into these three different categories: operating, investing, and financing. And then the ending is always going to be whatever ending balance is on your balance sheet. So, your operating activities are basically akin to how much did my business bring in cash from my core operations, my revenue that I'm collecting, the expense management that I'm doing? Am I collecting cash from my customers? Am I paying my vendors on time? This is a very important metric. Whenever businesses are being evaluated in terms of their financial statements, they're going to look at the income statement, how much profitability they're making, and they're going to look at their cash flow statement to understand how much operating cash flow are they bringing in? Are they collecting cash from their customers? Are they managing their cash appropriately? The next thing to look at is your investing activities, which in this example, you can see this business owner chose to invest $101,000 in property and equipment. So he's making a strategic investment in his business. So you say to yourself, wow, that's a lot of money. He only generated $24,000 of operating cash from running his business. How did he afford to do that? Well, if you look down on the financing section, you can see that he borrowed $109,500, got $10,000 on a line of credit, and he took out $99,500 in debt. So this measures activity from banks or investors who are putting money into the business. So, one thing to look at as you're thinking about your cash flow statement is how much money is coming in from my core operations. That's the most important thing to look at. And then you ask yourself, what am I going to do with that cash? Whether it's buying equipment, or am I going to be, paying myself back, or am I going to be, needing to borrow money because I need to maintain a certain cash balance? And then this is another, like the income statement, this is another key financial statement to look at over a period of time. So again, I like to look at the QuickBooks report that shows an income statement or a cash flow statement by a month. So I can say, what's happening with my cash flow month in and month out over a period of time, 6, 7, 8, 9 months. just so I can see if any trends are happening. And this is also a good way for you to understand how to predict what's going to happen in the future, because that can help you inform if you're going to be either needing to put money in or you want to take money out of your business, understanding what those cash flow trends have been and how they might shake out in the future. So again, each of the different financial statements are important. One is not more important than the other. It kind of depends what question you're asking. If you want to say, what's the financial health of my business as of today? That's the balance sheet. If you want to say, is my business profitable? How's my pricing? Am I managing my expenses? That's the income statement. If you want to say, how am I effectively managing the cash when I factor in borrowing, investing, paying myself and my core operations? That's the cash flow statement. So each financial statement has a different story to tell. It just depends on what question you're asking. So one of the questions that comes up is, what do I do with my profit? How much profit should I target? What do I do with my net cash flow that comes out? Like what do I do? Well, there's multiple different things you need to do, and then some decision points. The first items are always pay your taxes and pay your debt. Can't emphasize this enough. Always pay your taxes first. Make sure you are current. Work with a CPA to help understand your business taxes. I know a lot of our clients have LLCs, and that means that your business taxes interact with your personal taxes. So it's very important to make sure you understand your tax obligations, make your quarterly estimated payments if you need to. If you don't know if you need to, I recommend finding an accountant who can help you with that and help you determine what the appropriate tax strategy is. That's first and foremost. Second, a close second, is paying your debt, ensuring that you're current with your debt obligations as they are, as they're due, whatever, every month or every quarter, however often you have to pay them. And if you're having some issues, work with your lender. A bank would rather hear from you up front that you may need to consider refinancing or considering some different payment structures if you're running into some problems. So having a good conversation with your banker is always a good approach. Then, to the extent you still have cash and you want to make some discretionary decisions, reinvesting in the business. Are there things, capabilities, equipment, technology, whatever that you think you need to put back into the business that's going to make you better suited at doing your job and servicing your customers? Maybe it's that new product that you want to develop. Maybe it's investing in some inventory that you need to build a prototype or something. Reinvesting back in your business, you're putting money back in to help generate future revenues, and then paying yourself. Now, I always tell clients that these are discretionary decisions and always pay yourself last, but it is very easy for me to say and maybe hard for you to do because a lot of you are probably running these businesses. It may be your sole source of income. I know some of you are doing this with other things, and you may have profit goals, and that's okay. Just understanding that making sure these obligations are paid first will keep you out of trouble, especially with the government and especially with your bank. So just keeping that in mind as you go through this. So with that, that is the end of my prepared comments and prepared presentation. I'm happy to go through any other of these topics that we went through tonight. And I would love to hear any questions that folks have about this or anything else in the financial space that may be tangentially related to this topic that we've covered tonight. Kathleen, do we have anything in the Q&A box yet?
No, we do not as yet.
Anything that I missed that you would add or anything that I should go back and cover?
I wondered if you could cover a little bit more about what financial statements look like for a service business. Would there be something that would be similar to cost of goods sold that would have a different name or not?
It's interesting. I'm gonna pull up the income statement again here. So typically when a service business would if it's a sole proprietor or it's an LLC, like a single owner, and if it's a service business, they're probably not going to have cost of goods sold because they're selling, let's say, consulting service, or maybe it's a salon. Now a salon could sell products, so I'm kind of mixing examples here, but generally they're just going to have sales revenue, and then their expenses, they might be higher because they're the only expenses running through their income statement. Oftentimes we get asked, what's a good target profit margin? And it really depends. There's no magic answer for that. Profit margins in industries range from 3% in like grocery stores up to like 70% in certain technology companies. So there's no magic profit percentage. But I would say the big difference would just be that they wouldn't have cost of goods sold. And then if they've got employees, they're going to have the cost of employees in here. But if they don't have any employees and they're just doing the work themselves, then their expenses might be relatively light. There may just be things like, any office space that they may rent, or if they've got a studio that they work out of, let's say, or any utilities, or they're going to have business insurance. The key thing for them is going to be, how do I manage that sales revenue as high as possible and manage these expenses as low as possible? Because that net profit gets paid to you as the owner, and you're the only one getting paid. Whereas if you've got a team of employees, you've got to cover their staffing costs as well. So, is there anything else that you'd add to that, or that I should clarify?
No, I just thought there might be I guess there wouldn't be a unit cost ever if in a service business. I was just trying to think if there ever would be.
There wouldn't be a unit cost in the way you'd see like a retailer or a store, let's say, when they think about selling a product. But one thing that we talk to clients about sometimes is thinking about like an hourly rate. So, for instance, you know, we talk sometimes about this gets into a little bit of kind of budgeting and pricing, but more forward looking than backward looking. But thinking about a revenue goal, maybe a top down revenue goal. How many clients am I going to try to service over the course of a week or a month? How much do I charge for my services? Is it based on an hourly rate? And then kind of doing the math. We call it like, doing the math, proving if there's a there. Like, if I see X number of clients per week and I charge, $75 an hour, and if I do all that math, how much revenue does that generate? And if I plug that revenue into my model and say, if I could see X number of clients over the course of the month, I could generate this amount of revenue. That's more of a unit cost concept. And that could be the case of a salon. It could be like a massage therapist. It could be, it could be a consultant who's charging an hourly rate, or maybe it's a flat dollar amount per project, and that could be based on a certain number of hours. That's how I think about it for unit cost for a service person. One of the things that we like about doing that with clients, and I'm sure you've done this as well, is it kind of helps prove out the viability of a business idea in the early stages, where when you try to calculate how much revenue the business may strive to achieve over the course of a month, and then you see how many clients they need to service and how many hours it takes. And sometimes the math falls apart. And you say, well, I really can't service that number of clients per day, per week, per month. It's just not feasible. And then we have to revisit, okay, what's the model? What's the service? What's the hourly rate? How do you think about it differently? So that's the only thing I think about when it comes to unit cost for service businesses.
Okay, that's helpful.
Okay.
There aren't any questions in the Q&A box right now.
Okay.
Oh, we just got one. Do you recommend any software?
So the most common one that I've heard of is QuickBooks. I highly encourage people to check it out if they are interested in financial software. I'm not a user of it, but a lot of my clients do. There's another software called Wave. You can explore different options that are out there. My recommendation to folks is do some research. Check out if they've got like free introductory periods where you could try it out for like a week or 2 weeks and play around with it and see if you like it. Go on YouTube and look for YouTube reviews and see if people have recommendations about what works for you. If you've got a specific industry that you're in, and you're trying to incorporate other aspects of your business into your financial software, like billing, that may complicate your decision. Sometimes people will say, well, I want an all-in tool that keeps my financials and does invoicing and has a pricing component. Well, you may have to sign up for a deluxe model. So I would follow those pieces of advice. I think those are kind of the direct way to go. The other thing I would tell you is that you may find that you know you may not find the unicorn piece of software that has everything exactly the way you want it. So try to figure out the features that are most important to you. And if it's just a matter of keeping good financial books, and if you're in the early stages, Wave is a software that some clients of mine have used, and they've been pretty happy with it. FreshBooks is another one that a client of mine just recently started using. But QuickBooks is probably the most common one. Kathleen, any others that you've used?
No, I've only used QuickBooks, and I have to say it's a little bit complicated. And so I wouldn't necessarily start there if your finances are simple. I also would be careful about anything that might be free, just because you want to make sure that there's good security over your data. And if it's purely online, you have to just do some research into what's the reputation of this company. For example, Wave, I know that that's purely online, and QuickBooks is pushing people online.
Yeah.
And so once your data is located in the cloud, it's convenient, but it also runs the risk of have something happen to it. So you just want to be careful. You also, when you read reviews online of different softwares, because I run into this a lot when I'm looking for stuff, you have to make sure that it's not that the article isn't sponsored by somebody, because then they're going to advocate for the person who's funding them. And so you really want to make sure it's more independent than that if you're seriously looking for advice online, because at this point, so much of that advice is skewed by people being sponsored by one company or another.
Right. No, that's a really good point. That's a really good point. I did see
Evelyn
we
said,
got I'm sorry, Kevin. I did see we got a suggestion to ensure people know that use the Q&A button for any questions that you have, because we don't have the chat feature in this webinar. It is a good point on the reviews. You've got to look at both the good and the bad, and look at the averages, and sometimes YouTube tutorials can be helpful too.
and don't look at anything that says sponsored, or if the name of the company is one of the choices in the article. You don't want to read those, because they're
Right.
going to do a comparison that's pretty useless.
Right. Right.
Okay, we have a question from Evelyn. I attended another webinar for consultants. The trainer said we would want to earn 3 times as much as we did when on salary in order to make the same amount of money. Can you give any guidance on how to set our revenue goals?
All right, great question. I would say that I I don't want to judge the person who presented on that webinar, but I would say that any kind of general guidance like that is very high level and very general is probably not going to be as meaningful to everybody. It's kind of like some of the investment advice you read where they say, oh, you should have your portfolio be this and this, or you should only take out this amount, when you retire per year, things like that. There's generalizations that could apply at the various high levels, but when it gets down to the individual business, it really depends. My advice to people to think about revenue goals is to there's a lot of factors to understand. You got to understand what the market is, and understanding just how big is the market that you're trying to reach, what's realistic for you to reach, and then what's your capacity. Going back to if you were to use, I'm going to come back to a consultant example in a minute, but if you're to use like a machinery a machine that produces, a number of products, a number of widgets per day, how many widgets can the machine produce per day, per hour, and what do we sell them for? Like, there's simple math that you can do to kind of carve that out. And if you had the machine running for 12 hours a day, what could it produce, 6 days a week or whatever. When you're thinking about consulting, it's a similar pathway, but you know that you're not going to be, actively working every single day, 10 hours a day, filled up with jobs that are always going to be paying your hourly rate for 60, 70 hours a week. You're probably going to have ebbs and flows, especially when you're first starting out. My recommendation for revenue goals is to think about kind of what's the art of the possible? How many projects do I think I need to sign up over the course of a month or 3 months? And if I charge an average amount per project, what does that math look like? If you have different project types, maybe you've got one-off services you provide versus kind of large projects. Maybe you say, well, if I could get 2 projects this quarter and 7 of these one-off consulting contracts, what does that look like? And then you have to ask yourself realistically, like, is there a market enough for me to find all those clients and sell to them and deliver that in that window of time? Is my hourly rate competitive to achieve that? And there's a lot of questions in that, and there's no easy answer to it. It kind of goes to the question of how much should I charge for my services? And the answer is it depends. The only right price is what a willing buyer and seller are willing to engage in a transaction on. And, there's this concept of price elasticity where, if the business pushes their price too high, at some point the customer is going to walk away and either not buy it from anybody or go to their competitor. So, and then if the price goes too low and you get a ton of customers, the business may go out of business because they priced their product too low and they're not making enough money. So that's that price elasticity that comes in. So that's a very long way of saying it depends. And my recommendation would be to kind of do some scenarios, do some high and low scenarios, thinking about what the art of the possible is and asking yourself, how many projects, thinking of breaking it into how many projects per month, average dollar amount per project, and what's the art of the possible. That will help set some guardrails for you. Kathleen, anything you add to that? You work with a lot of clients in the service space.
Yeah, and I hired a lot of, they weren't really consultants, but they were contractors. And as a company, we hired a consulting company, which was one of the big 5 consulting firms. One of the things that's important to know, depending on what kind of consulting we're talking about here, is that what a company will pay one of those big consulting firms is more than what they will pay a small consulting firm. And part of the reason why those big consulting firms get what they get is because they've got a lot of overhead and marketing costs, et cetera, that they're baking into their price. And also, they've got some really, really high level consultants that you're paying for. If you're hiring contractors, then generally the company's paying a contracting price. And obviously the actual person delivering the service doesn't make anywhere near, it's less than 50% of what's billed in every case. So that might be the rule of thumb that this person was trying to describe to you, is that you need to charge more out per hour than what you personally would have been paid as the employee. But it's usually not 3 times, it's closer to 2. And it's not always going to work because companies are going to have budgets in their mind for what they're willing to pay for these consulting services based on what they've paid for them before. And so if the math doesn't work for you, then you're going to want to turn it down, because our company would pay anywhere from $70 an hour to $250 an hour, depending on what type of person we were looking for.
Right.
Now, if you're in a field where it's highly sought after and extremely rare, then there's kind of almost no ceiling as to what you can charge. So that's why Steve said it depends, because there's no really hard and fast rule. It's a lot of it's dependent on what the market will bear, what other companies are charging, and how they look at you. If you're small, if you're a solopreneur, for example, they're going to look at you a little differently than they're going to look at, say, Accenture or one of those big companies. So
Right.
hopefully that's helpful. And if you have any more specific questions related to that, feel free to type more in the
Yeah.
Q&A box.
And before we wrap in a few minutes, Kathleen, can you watch the second poll?
Sure.
This is just if you're interested in working with a SCORE mentor, if you're not already, I'll send you an email and let you know how to do that. So if you are interested in working with a mentor, the second question, just answer yes if you'd like a mentor, and I'll tell you to do that. is the only email you will receive from me. We will not bombard you with emails, but this is a way to offer you some guidance on that. And in terms of the revenue goals and the pricing, it is complicated. I do wonder if sometimes people may get that guidance about having to earn more because you've got more of a tax burden on yourself and the entire cost of running the business are on yourself. And there's more aspects of it that I can see why people are saying you need to quote earn more. But at some point it comes down to what's that client willing to pay? And, to Kathleen's point, if you've got that industry expertise, that goes to the point of the competition. If your service is very, kind of a commodity or it's homogenized where there's a lot of people, then it comes down to how are people finding you? And if it's a physical location, there's geographic questions about who's, in your immediate geographic area, or if it's online, how are you finding your online presence? But if you're in a specialized industry, something where you've got a unique expertise, that may create a market where you can charge more because people are going to say, well, he's the only person we can find. We're willing to pay that higher price because we know that they're the expert. We can't find anybody else. So capitalize on that and leverage it. And I always think about this as you can always put a proposal out there and then say to the customer or the client, hey, if this isn't in the ballpark of what you're looking for, let me know. Let's talk. Maybe we can rethink about the scope or kind of rethink what a different option might be. And you also may find that if you're just starting out and you want to build a relationship with that customer, you may find yourself wanting to offer them a little bit of an introductory price and say, hey, look, I'll do this piece of the project at a lower price, but let's kind of build on something further, for a second project down the road if you're satisfied with my services. So there's multiple ways you can play that strategy. So, all right. Any other questions? I don't see anything else in the Q&A box. We'll do a last call here for questions. Some good ones tonight. Thank you. All right. Could probably end the poll on the mentoring, Kathleen. Thank you for that. And those folks who answered, I will reach out to you later. So we'll go ahead and wrap up. I want to thank everybody for joining tonight. I hope you enjoyed this session. We've got a lot of educational content on our YouTube channel, and you can find that by going to YouTube and just searching for SCORE Greater Hartford. We've got webinar recordings of all the webinars we've done the last few years. They're organized by business topic. We've got playlists, all sorts of great information. And while you're there, if you subscribe to the channel, you'll be notified every time a new video is posted. And you will receive, if you're here tonight live, you will receive a link to this recording tomorrow. And if you need any help from SCORE, this is what we love to do. We love helping business owners solve their problems. It's what we're here for. So you can go to score.org and you can sign up for SCORE mentoring and whatever help you need, we will be there for you. So with that, I think we will stop the recording and end tonight's webinar. I want to thank everybody for joining.